Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, we are live here again for the Investor Podcast. Really excited to have my guest on, Ken Mahoney. Ken Mahoney is the CEO of Mahoney Asset Management, where he offers clients tailored retirement solutions. He's using data provided by leading financial research companies, Morningstar, Standard & Poor's, and they provide detailed performance analysis and investment recommendations for goals like preparing to leave your job, purchasing a second home, or planning retirement, because all of us are kind of going through these different changes. Because of Ken's comprehensive financial experience, he sought out after CNBC, Fox Business News, Mornings with Maria, The Today Show, CBS, ABC, and the Investor Podcast to speak on topics such as planning for retirement and stock market investment strategies. He's also frequently quoted in leading newspapers and magazines, including the New York Times, the Wall Street Journal, Chicago Tribune, CNN.com. And Ken is on the radio daily, delivering market reports on the WHUD, the Peak, the WRCR. And on Sundays, Ken hosts a well-known radio program on WHUD called A GPS for Your Finances. So, Ken, really excited to have you on the pod and happy to go deep on.
You can tell I'm all in, right? I'm all in this stuff.
You are. Yeah, and I think it's important. I mean, if you are not all in, it just takes like one day to fall behind, right? Because there's so many changes.
If you're trading, if that's part of your thing, and you have a cold or you have COVID and not feeling well, take the day off. Seriously. You really have to be all in, sharp, ready to go every day of the week. I make mistakes. Again, that's just a little sidebar, but I thought about times where I'm like, you know what? I don't feel good. Pull back. If you feel good, you gotta be all in. There's nothing in the middle.
Yeah, no, I totally agree. And a couple more plugs for you. Ken is an investor and author of 9 books, including 10 Things to Do Before You Retire and Not Your Father's Retirement, and licensed financial advisor for more than 35 years. And he's also considered by the financial industry as an established financial professional. He was recruited to serve on the House of Representatives, Banking and Financial Services. And in this capacity, he advised the chairperson of the committee, Congresswoman Sue Kelly, on the impact of new financial regulation. So congrats on, just such a celebrated career, Ken, and I know there's still a lot to come. So hopefully I did a good job with a high-level overview.
Yeah. I was listening. I was like, well, who's got time to do all that? Oh, I did it.
Yeah, exactly.
But, look, it's content creation, it's distribution, it's all the things that, that this show is known for. And again, nothing comes easy. Everything is a journey. I love it one day the Beatles became famous and coming to New York. Beatles spent about 8 to 10 years, little clubs, 60 people. So nothing is an overnight success, including the Beatles. Yeah.
Absolutely. I mean, I know a woman who's raised, I think, over $75 million, and it was just, over a period of a handful of months. And it was really because she built a huge following on TikTok. Right. So people, obviously you're not allowed to publicly solicit your fund, but you can share content, you can share your personal brand, you can share things that you're going through. And, I think that's the future of media, right? We're going to still have CNBC, but, people follow, who do they follow, right? They follow Mad Money. They follow a specific personal brand, a person that represents the face of that platform. So I feel like there's going to be a lot of people that are going to be empowered to build their own media platforms just with their mobile phone, essentially, and it's already happening.
Right.
Yeah. Well, why don't we start from the beginning, Ken? And you probably do this periodically, but I want our audience to know who Ken is, right? As everybody knows, our audience is mainly institutional investors, corporates, fund managers, LPs, people that are looking to get into the industry. We talked about, some of your platform, helping people think about what's next when they're trying to leave their job, right? So a lot of people are in different situations in their life, right? They're worried about their kids. They're worried about their parents. They're worried about if they're going to make their next mortgage payment, right? So lots going on in their mind, especially with the people that are listening in. But tell me who Ken is. Where did you grow up? What did your parents do? What did you think you wanted to become when you were earlier in your teenage years, and what was going on in your mind as you started college, and then we'll take it from college, and then
I do have to start my teenage years, or at least 18, because I tell my kids, they don't believe me. My first check was $3.40 an hour. I worked at the AP pushing carts around and stuff. And I did get a raise. Some months later, I was very proud of this raise for $3.45. Now, even back then, that didn't buy much. But it was my parents saying, like, you got to have your work ethic. So my dad was a sheet metal worker, always in the elements, always wanted me to go to college and not go through what he went through. My mom stayed home. Mom took care of things. And, the traditional kind of my three sons or leave it to Beaver, be home at 5 o'clock, dinner on the table, the traditional way, which we lost a lot of innocence, unfortunately, over the years doing that. But anyway, so I ended up going to SUNY Oneonta, and actually was a shade student also in London, where I studied economics, Ealing College, West London. Then I came back to the States and finished my master's in psychology, because I was like, I can't do 2 or 3 more years of it. So I came.
How was it studying in London? What were some things that you experienced being in London?
Yeah, I don't know how I did it. So I was 19 years old.
Yeah.
At 18 years old, my mom was very sick, and I stayed home. Thank God she got better. All my friends are zipping around the world, the country, and I'm like still at home. And I felt like I want to do something. And how I picked it, seriously, I saw a little flyer back in the day, and you rip off part of the flyer with a phone number. Again, no internet. We're talking about pre-internet days. And it's a phone number. And I called and said, yeah, they're looking for exchange students. And I thought that'd be adventurous. When I first got there, Joel, I have to tell you, while it was adventurous, how can I say this? I was really homesick. It was like, what did I just do?
Sure.
But it challenged me to learn that the world's bigger than the United States. And with a $5 or €5 a day Euro pass, I went to pretty much every European country.
Yeah.
I was able to study economics. I was able to go to Bath, Cambridge, so many institutions. And again, 19-year-olds, you can just suck that all in. And so I look back at myself and said, thank God I had that start. That was really
and it just kind of counted as a semester.
Yeah, so one semester, and I traveled after that. And then I came back, and I was like, okay, it's 1987. I was either going to go to psychology or the markets. Either way, I needed more time. And so starting 1987, remember October 19th, the stock market crash.
Yeah.
Not too many firms were hiring in 1987. So I said, I'll go back 2 more years of master's. A lot of it was paid for because I was an RA. And then I came out, and definitely I want to do the Wall Street thing. Now, when I came out, I didn't have a lot of contacts. I went to Merrill Lynch, was like, where's your book? I'm like, what's your book? My pamphlet? I don't know. So believe it or not, at that time was all these penny stock operators like F.D. Roberts. And if you remember that whole yucky Blinder Robertson or Blind U Robin, all these penny stock firms.
Sure.
So I didn't want to go there. The first firm I worked at was David Lerner Associates. They advertised a lot of CBS radio in New York.
Sure.
I met a couple of guys there that kind of liked them. And I was a bond broker first couple of years. I kind of cut my teeth in the industry with David Lerner Associates, and I learned a lot from that. But from there, I've always had a passion for stocks, and my kind of hop, skip, and jump was to that of Payne Weber. People remember Payne Weber. They bought Kidder Peabody, then they were bought by UBS. But there's some very famous, I don't know, Joe, if you've ever seen these commercials, these old commercials, when Payne Weber talks, people listen. It was those days, like they had some type of stock tip. If not, you should look it up, or your viewers look it up. So that's kind of where I got it. And then from there, Prudential. And then at some point, I was year 1999, 2000, I was ready to go on my own. I wanted to do Mahoney Asset Management. I learned a lot through the wirehouses. I learned a lot that could go right. I learned a lot of things that can go wrong. I learned a lot of things were proprietary still back then. And so then I launched Mahoney Asset Management about 25 years now.
Yeah. I want to go back to your international experience when you were just studying in London, right? I mean, what were some of the things that changed your perspective on the world when like maybe things that you experienced as being in Europe and traveling and being in London? I mean, how did that change your perspective on life and just kind of how
there's
the world
just so much
works?
history there, my friend. I mean, I go down to New York City, and I was working in the city of Payne Weber and all. Yeah. And you see a building like 1955, like, wow, look at that building, look at the architect.
Sure.
You're now looking at things in Cambridge where they start like 1485, or Buckingham Palace, the monarchs. It was like the history there was like, it was hard to even wrap your head around it. Wait a second, that building's 900 years old. Like, what holds that up? And my perspective in New York City, just one example was like, say, 55-year-old built 1955 or after the war in late 1940s, and how cool that was. and you realize Europe was way, and I felt Europe was ahead of us at that time.
Sure.
Whatever the technology was at the time, but definitely infrastructure, trains. I look at it as a kid, for 3-4 pounds a day, I could zip along, use the bus, use the tube, as they call it. But only the tube, I could also bop around different countries. Like if you're in New York, you go to Connecticut, Jersey. You're in London, you could go to Ireland, you can go to France. You just hop along.
Yeah.
So I
remember when I was in my it just gives me a fond memory. I mean, when I was in my early 20s, I started out being, as an engineer. So I was making good money as an engineer back then. And I met this guy that was kind of like-minded, and we were like, hey, we should go to Europe. And they had this group. It was, I don't know if it's still around. It's called Contiki. And essentially what you do is you pay a flat fee and they organize everything for you. And it was so cool because him and I went, obviously we had no responsibilities, right? We were early 20s, making money as engineers in the aerospace industry. And what was really cool was everybody there was from a different country. So people would just share like kind of their experiences, just like a huge cultural experience. And I think the time that we went there, we were in London. There was a World Cup. So it was just crazy at that time. Everyone was just really, going berserk over just kind of what's happening, with the World Cup. But it was just a different culture. People, they say like, when you go to Italy today, right? I mean, people are drinking wine, eating pasta, eating bread for 3 hours, right? I mean, so there's not the stress, and kind of the things that people deal with over here in Europe. I mean, people are just kind of less worried about it. So yeah. Can you still hear me, Ken?
Oh yeah, sorry about that. Yeah.
No, it's okay. So yeah, I was just saying, about Italy, right? I mean, people just kind of going there. It's just a different culture. People, their priorities are a little different. Than they're more worried about the human being versus here. It's like more, right? How do I get more alpha?
But Italy gets more and more. They get more and more vacation time. It's 4 weeks a year, then it's 6 weeks a year, then it's 8 weeks a year.
Exactly. Yeah.
Yeah. So I went to Italy and England last year, the year before. We pretty much go once a year to Europe. I just still love going to London.
Maternity leave in Italy is like a year. I mean, over here, maternity leave is 2 weeks, right? It's elective maternity leave.
Everything's different.
Yeah.
Yeah. They eat too late, though, I have to say. That's the only downside. For me, like around 9, 10 o'clock, I'm ready to wind down. We have reservations day 30, leave there at 10:30, 11. Let's start the next day. But you're right. It has to slow you down. And that's what's the great perspective about Europe is that they have a work-life balance, life balance that we all would probably want instead of the 12, 14-hour days that we put in.
Yeah, I mean, I had, so part of our team is remote. I hired somebody from Sweden, and he's like, oh, I don't respond on the weekends. And like, I was just like, it's not going to work out. So what's that?
Like, you write to somebody, right? And then the auto reply comes back. Oh, we'll be come back. We'll be back May 30th. And you look at your calendar like, what? A month? If I ever put an auto reply saying, oh, I'm out, for a month, I think there'd be nobody. It's like the door. Yeah. The lights would be off, so to speak. But it's kind of funny. Every now and then you'll write to a European counterpart, and you'll get this out of again, which is common. But then you look at the calendar and say, "Wait, that's 20 days. Well, 30 days."
Sure. Yeah, absolutely. So so you started Mahoney Asset Management as kind of the next step, right? Kind of worked in wealth management and asset management so tell me what was going on in your head, and how kind of the origin story of Mahoney Asset Management.
Right. I've always liked the planning aspect of it. I mean, that's where I feel like I'm making the most impact. And people are making decisions around some of the stuff we do. Now, I trademarked a GPS for retirement, GPS for finances, but we created a GPS, which really, it's a financial plan, but it breaks it down so the average investor can look at page 8, get a 30,000 feet view, what their expenses are with inflation. And they're looking at all this stuff. And, that changes lifestyle. For some people, it's like, wait a second, I can retire now. I'm like, yeah, I was there. I'd retire 3 years from now. So it's very impactful. What comes out of these meetings, again, asset management, we'll talk about that, I'm sure. But to me, where I feel like I have the most impact on families' life to help them, whether it's legacy planning, whether it's, retiring sooner or maybe retiring later, or maybe they're saying, hey, my expenses are going to be $70,000 a year. Why not make it 90, be a little bit splurgy? the extra $20,000 per year, take that trip to Italy or Viking cruise, whatever the case is, and still make the numbers work. So again, it's great to see that you could elicit change, that you can help somebody, and then they're all in. And then the asset management part of it is different, obviously, but to them, for most people, that's where they get the value out of with our firm, is the constant planning, updating on an annual basis. Are you on course? Are you off course? Using some cliches around GPS. But we get it. If you go to GPS and you have a wedding, Joel, this weekend, and you're in a city, let's say goes out to Long Island, you're not going to wing it, right? You're going to put your GPS and it's going to show you kind of how to get there, some rerouting. Same thing here. Once you have a goal, GPS is a goal, whether that's going to a wedding or, hey, I want $10,000 a month when I retire, then we back into that, right? And there's some rerouting that happens to that too. But then most investors who don't understand beta and alpha and, moving average, convergence, divergence, and all kinds of technical things, but they do know what a GPS and they know how to use GPS. And now we're making it for them to create their own GPS and their own lives.
Sure. That's helpful. I mean, what I think is interesting with the audience that we have is there's been a huge interest in asset allocation. So a lot of these families that have come into wealth, would love to hear some insights in terms of trends that you're seeing, obviously with the higher tier clients that you see in terms of like wealth preservation, compounding wealth, and then kind of thinking through, how they're thinking about legacy preservation with their next gens and how these conversations are being made internally with the family. Especially in New York, right? There's a lot of single family offices that are thinking through that. They're family businesses. Sometimes the kids don't want to be involved in the family business. The kids want to do something else. They don't want to run an Italian restaurant for another turn. So would love to hear some insights, and I know you're in Florida now, so we'd love to hear the flip side on that in terms of how families think about that, in Florida, but, in your times in New York, some of the, wealthier families that maybe you've advised, what was going on in their mind?
Yes. So a lot of it, they understand, especially someone who's more sophisticated with investments in the world, is that you really try to stack returns on top of stack returns, right? You try to stay away from big drawdowns. If you're down 20%, takes you 30% to get back to break even, right? If you're down 50%, God forbid, you'd have to double to get back. So they kind of get that. And they also understand that the eighth wonder of the world, according to Albert Einstein, pretty smart fellow, is that compound interest, right? So we're on the same page, and sometimes you have to reduce the risk tolerance to make that happen. So we are growth managers. So we do it gets a little bit bumpy in the left lane, but this is a once in a generation, we believe. Last generation was the 1990s, to be able to, allocate money that you're still not going to need for a few years, even if they are retired, and find yourself in that kind of bumpy left lane, growth lane, so to speak. We don't have an allocation for bonds right now, currently. We feel rates can go higher. Inflation may be a little bit stickier than most people like to talk about. So allocation stocks and cash. And then, we know we have volatility. We can make it a friend or a foe, and tend to make it our friend. And the strategy around that is, big picture and then kind of narrow it down. But be tactical. So let's say you like Microsoft. A lot of people will buy Microsoft, let's say one shot, and they don't buy an increment. So if it falls against them, like there's 420, 400, 380, go in and add to the position. Most people, it's one and done and so forth. So, the tactical part of it, your friend, and again, this March was pretty ugly. Yeah. But we were looking at the oscillators, which were deeply oversold. So many companies below the 200-day moving average. So using some technicals there, right? In addition to that, the VIX hit 30 at the worst level, but was hanging in the mid 20s. And that's kind of, you have 25, 30, you're having 2-3% intraday moves, shakes people out. But that's time to be adding to your portfolio. Conversely, not to throw a wet blanket on what's happening here in April, but we're taking some profits. We want to build some cash for the next whoosh that we'll have down, whether that's from Iran, we don't know where it's going to come from. But that's how you make volatility your friend. You actually expect it. You make it part of your plan, and then you execute when it happens.
Yeah. And then when it comes to, because you're thinking through, when you think about wealth protection, obviously you're thinking about insurance products that could, help with some of that, right? And then when you're looking at compounding interest, What are your thoughts in terms of individual investing into constituents versus just kind of having more of an index strategy for growth? I guess, do you get higher alpha if you just kind of selectively, directly manage, individual investments, or is it better to kind of have a blended, fund to funds approach where you're investing in multiple, indexes that generate some type of proven returns over time?
Right. So again, our kind of base would be ETFs. Our favorite still is QQQ, the Nasdaq
Yep.
100, Apple, Microsoft, Google, the video of those names over the S&P 500.
Yeah,
The S&P
QQQ is a little
500
more high growth as well, right? I mean, that's what I've
and then
yeah,
some individual stocks which
yeah,
represent the
hmm
AI. So again, we like the
exactly.
infrastructure plays.
Yeah.
GEV, the spinoff of General Electric, and they provide all the generators.
hmm
VRT, Veritef, they cool down all these data centers. They're picks
Yeah,
and shovels. We love picks and shovels.
sure.
We're not sure which is going to be the chat
hmm
GPT of the future. We're not sure
Sure.
what AI is going to be the kind of mainstream, but we do know the picks and shovels are going to have to be used
hmm
for the rollout of the data centers and so forth. And clients,
How would you
I
how
think,
would you think through the weightings of the indexes? So, like, with QQQ, right? That's high
yeah,
growth. To offset some of the risk of the high growth, what would you recommend in terms of kind of balancing that out? Maybe do like a VOO, or kind of like some of the well-known S&P 500 indexes to balance that out?
yeah. So I'm not a fan of SP 500. I think there's just too many
Yeah.
industries that are
hmm
out of favor. I think it's over diversified. But to your
Sure.
point, there's a lot of ETFs out there. I can name one. I can name a couple for you. But
hmm
QQQX, the Nasdaq 100, selling calls against portfolio year over year up about 16%. Dividend dividends created by selling calls 8%. So again, we kind of
Oh,
like
that's pretty
that's where we're
good.
trying to stay. Yeah, we're trying to stay away from the
hmm
income. Again, we really think rates can go higher. And
Yeah, yeah,
if
yeah.
you're looking just for income, that's fine. And your
Sure.
bonds mature, but they don't mature.
hmm
Coming again, my background coming from a bond house,
Yeah.
knowing that again, we're hoping for a stronger economy.
hmm
I'm hoping the Fed. Be careful what you wish for. I hope the Fed doesn't
Yeah.
cut rates. That the
Sure.
economy is humming along. That's going to help grow
hmm
stocks and so forth. That's our theory. But we'll be tactical in between. So it's stocks and cash, not really like in bonds too much. But to your point, how to generate some extra income in the portfolio. Again, we like some of these ETFs that sell calls, in this case QQQX, and
hmm
generally reaching a 7, 8, 9% distribution of selling the calls, collecting premiums.
Sure. Got it. So it'd be about, yeah, so it'd be the QQQ and then also kind of the other vehicle with the X, to kind of get
Right.
some of those dividends. I mean, yeah, look, it's looking like it's around 7.74, hovering around the 8% dividend, which
Yeah.
I think is great. I mean, you're not going to get
And,
that a lot of times in
and
the
look what
U.S.
it's doing year to date, what's done in the last year.
hmm
And actually, if people say, hey, QQQ,
Yeah.
a little bit too much risky. QQQX still gets the
hmm
holdings, but selling calls and reduces risk because you're bringing in income.
Yeah. And it hasn't been, I'm looking at it from a year to 5 years. It hasn't been crazy volatile. I mean, you're looking on the high end for
Right.
QQQX, you're looking at like a 30.43 dollars, and then kind of the lowest, the lower numbers you're hovering the 20s, right?
Right.
But
Yeah. Yeah. If you look at it, yeah.
overall it's kind of been pretty stable
Yeah.
periodically.
Nasdaq was down 200 yesterday, give or take. And it was
hmm
down 50.
Yeah.
Like, really.
hmm And then when it comes to like legacy creation, when families are thinking about kind of passing this down to their children or their grandchildren, what are some of the conversations? Obviously, could be spoken about more broadly, but just kind of some of the signals or just patterns that you've been seeing, with just kind of managing it. Essentially, they call it decumulation, right? As you're kind of
Right.
getting
Right.
older, there's a book. I mean, I highly recommend it. It's called Die with Zero. It's about just
Wow.
essentially after you've paid your kids, after you've kind of given everybody what you think you want to give them, whatever's left for you, you want to enjoy your life and spend that as long as you've kind
Sure.
of taken care of everything else. But that's essentially kind of the decumulation process. So, how have you what are some of the things that you've learned kind of working with people as they're kind of, getting towards the later parts of their life?
Right. So sometimes it's two camps. I mean, we've even heard like Warren Buffett, again, not directly from me, but saying he didn't leave a lot for his children. He wanted his children, Mr. Wonderful, Shark Tank also. So again, I say two camps. One camp that says, hey, you know what? I built my thing. It's not going to help you if I just give you everything. So I got that camp. The other camp is like, hey, I'm going to leave a lot for them. I struggled. So it's coming from, but it's
Yeah.
coming from different bases. So to your point, though, I think most of our clients that are doing this, whether they're bequest or whether
Hey, Ken, I think you broke up for a second.
Just off to, I have the internet guy coming.
No, you're good now. You're good.
Okay. You'll be able to edit that. Sorry about that. It happened a couple of times when I'm rambling here. And so, for those clients that really want to give to the children, a lot of it with some strings attached. That is, they understand, someone getting $10 million at 25 years old can actually really work against you, and I'm not blaming any 25-year-old. I was 25 at once, and I'm glad I didn't have $10 million. I may not be here, but let's say in that example, but
may not be alive.
Give them a certain amount of income each month, give them a amount of whatever, but make it over, 25 years old, and then another amount of money at 30. So if they didn't really figure it out at 25, they still have a few more years to figure it out, right? And then maybe at 30, 40, and so forth and so on. So I see a lot of that kind of laddering, let's say, to the children to make sure that they still gifting, but not on one shot, because they also know.
And also, the thing that I took away from that book, Die with Zero, is like, you don't want to give money to someone when they're 60 years old, right? That's not when they're going to enjoy the money. I mean, when you're in your 30s, you may be starting a family. You want, obviously you could use it. You could buy a house. When you're 60 years old, I mean, you could, you're lucky if you can continue to, have the same mobility that you had, in your 30s, right? So I think that's also an important point. It's like the prime years where you can kind of really enjoy that wealth is kind of essentially, in your maybe early 40s to beyond. So, yeah.
Yeah, like and also what I like our approach, and again, other wealth managers too, is nothing we do is cookie cutter, right? So even in that planning and in-depth planning around legacy, everybody has different. So even the husband and wife sometimes have different views on it, and they have to kind of figure out a strategy that they could both kind of live with. So it's not, again, there is no cookie cutter. Every family is different. Every family has goals and objectives, and we try to work through it. I also tell a lot of our clients, whatever we set up, remember, we're not estate planning attorneys, but again, we refer them to estate planning attorneys. Most of it we recommend are revocable, meaning all of a sudden your son, it turned out to be not that nice of a kid, let's say, you could always change it. And that flexibility gets people going forward, right? So a lot of people say, like, I don't want to do something because if I want to change my mind, like, no, you should set up with the most amount of flexibility that you may change your mind, and you may be able to change the documents or who are going to be the beneficiaries, primary, contingent, and so forth.
Sure. That makes sense. I would say, I mean, I totally agree with that. There are those two camps, and there was somebody that I saw on my feed, maybe about a year ago. I mean, he was a billionaire, and he was just saying, it's like, look, I mean, there's no matter how much money you're making, there's only so much that you can really spend, right? Like if even if you ate out every day and ate at a 5-star restaurant every day, but $300, that's not going to really exceed more than maybe maximum like 30 grand a month, right? So there's a point where like your living expenses, just to kind of still have a good life. I mean, there's a number that you just can't really spend. If you really tried, I mean, it's just tough to spend that amount of money. Now there are people that can, obviously they're buying,
start buying jets and yachts.
Like
some
of
the best days in life. I mean, some of my best days were hiking with my 2 boys. It costs nothing, get a sandwich, so it's not always, sometimes you may go to a restaurant you said for $300 and you didn't see the waiter the entire day. The food wasn't good. So again, how we spend money also, we can live abundantly, and we don't even have to spend a lot of money with so many different choices.
Sure. And, along with just kind of, so, obviously, you need to think about the trust and, the estate. You need to think about, obviously, insurance products that can kind of, have the protection that you need to kind of support your family. If something happens, be able to protect their family. And then obviously you want to have growth, right? Are there any other components when you're thinking about a financial plan?
Well, again, we said insurance. Most of the time we look at, again, we have specialists at our firm. I don't handle that, but I know quite a bit about it, being licensed and all that. But life in the hybrid long-term care, because, someone has a long-term care and not have life, you maybe put money towards that. And thankfully, hopefully you never find yourself in a long-term institution, but you're throwing money away basically, because it really, that money should either go towards one's passing, unfortunately, again, that's for legacy planning. But the hybrids, long-term care and life insurance, are definitely a lot more. And by the way, sometimes we review a client's portfolio. Let's say they've had a good year, they've had good growth, but if they don't shut the door to risk, and that risk is the long-term illness of one spouse can wipe out the other spouse. And it can happen pretty quickly. 10, 12, 15,000 a month is not unusual for nursing homes these days and long-term health. So
Yeah.
if you're really going to get around planning, and it's not a fun one to talk about with clients, but usually it involves long-term care. But for us, the strategies we like are really the hybrids that include both life insurance and long-term care.
Yeah. And then with long-term care, I guess if you were to kind of enroll in long-term care, there would just be a premium that you would pay today.
Right.
And I guess in the event that would happen, then the 10 grand or whatever, 10 to 15 grand, I guess, would some of that be subsidized because you paid a premium, or would you still
yeah.
Okay.
Very expensive though. It's not easy. It's not an easy call. It's not an
Yeah.
easy call. I mean, some clients say, I'm doing it for my children because I can get wiped out. And look, in our family, my grandmother, she took ill. My uncle took care of the house, which he didn't. And the house was sold to pay for the nursing home. And then my father said, that's not going to happen to you guys. We're going to make sure we break that. So there is definitely the way to kind of deal with it. It's not just long-term care for the spouse, also long-term care for the next generation that, the spouse is sick for 10, 8, 10, 12 years. There may not be much of an estate left after all, God forbid that would happen. And that's not to scare everybody, but it's also very expensive to get. It's not an easy decision. So I'm not, it really depends on the situation.
I think there's some, look, I mean, we know people from ethnic backgrounds that, end up sending their elderly, family to just sending them back home. You go back to India and, it's just much more digestible. It's much more affordable, right? And, the care that you're given there, it's essentially almost like in a luxury. I mean, I wouldn't say it's like a Ritz-Carlton, right? But it's a nice facility that, gets you the care that you need. Obviously all the support that you need, and the staff and the medical attention is there, and it's at a fraction of the price. So I think there could be some innovations and there already is in terms of medical tourism, right? If you got to get your dental work done, you could do it I know that, I haven't had to have any dental work, but I've had family members that have gotten stuff done for like a fraction of the price in India. They're going there to visit family. Might as well get a crown in,
Yeah, no, I know family have gone to Brazil and for a fifth of what, or a tenth of what it costs here in the States. So there's different ways to handle it. And it depends. Some clients are all in as far as whatever it takes to make sure I protect my son and daughter. And that includes life insurance, hybrid, long-term care. Let's do it. And others say, hey, I worked my tail off. I got this. Whatever's left is gravy for them. So it's two different schools of thought.
Well, look, there's a lot of innovation, right? Do you think you and I will be taken care of by robots?
Maybe it may happen in next week. The way I just saw, by the way, out of Japan, one of these robots working with the airlines, out there, and kind of cleaning the airplane and this and that, and you're sitting there saying, wow, the uses just go on. You can imagine. That's a tough job for someone to be down on the tarmac with the beating heat and the fumes and yuck. Everybody's kind of all over this and saying AI is going to galvanize jobs. That's not a really good job for most individuals, right? So if you replace those type of jobs, I know I skipped a beat here on this, but just reminds you where we're going. And when I saw this robots, I should say, at this Japanese airport and things that they're doing, I'm like, you get kind of where this is going, including, you said, healthcare. Yeah, I went to a restaurant in Florida, and it was a robot-ish, and it came up with a tray and plopped in front of us. Now, it was more for show, and probably attract business. But it did. It actually stopped there. We picked a thing. It went off. We clicked some things. It came back over again. And, of course, this thing was running around the restaurant on a piece of it. But pretty soon, that's not going to be just for fun. It's not going to be just for games. It's not going to be just for entertainment, for bringing in business. Pretty soon, that's going to be, where we are.
Yeah. I think there's going to be a point where there's a inflection point where the cost will really drive people to just trust robots, right? So right now people use Waymo. Waymo is completely autonomous. And if Waymo is, probably $5 to $10 cheaper than Uber, people would probably stop using Uber, just because it's, they're willing to take the risk. And
I'm old school. I'm Uber still. I would still be like, I still want to talk to somebody in case I cheat, whatever the case is. But I totally get it. My son was off in Austin, Texas, where actually he was visiting some friends there. And the first time he did a double take. The husband and wife got in the back of the car, no in the front, and zipped off. And he just sat there. He said with his mouth open. And remember that they did a lot of pilots there, of course, in Austin, Texas. He happened to be there visiting friends, but he said it was just, it's going to take some time. You're going to have that reaction at first. Like, what? Where's it? Like RoboCop or whatever the movie, Last Recall, whatever these kind of futuristic movies back in the 80s and 90s,
Yeah.
and here we are.
Yeah. Where do you think the innovation is going to be in the investment space and also in the wealth management space?
Yeah, so I think there's gonna be a lot of AI use. Like, look, we're using more in our practice for touches. We still have a rule. Again, we had a staff meeting the other day that we still want to handwrite, type out notes. Again, some of these things look way too polished, and I really want to come from us. But for us, as far as asset managers, as far as screening, especially with growth managers, we're looking for, companies, let's say, over the next 6 months, over the next 3 years. Again, other criteria, put in institutional interest, low, high, whatever you want to do. So we're using that, and actually that's really good. A lot of our research which is quite cumbersome before, as you know, it aggregates all this stuff. So I think in our practice, we're using it for investment selection. But as far as the touchy-feely that our clients like, and most of them are older, we still want staff to reach out by phone and email with their own notes. And not get, I don't know if you've received, but I'm turned off when I get an AI obvious letter that I don't feel someone's put any time into it. So I think it works very well for productivity, but I also think if you're going to lose the customization or the personalization over AI, be smart in your business about what you send out to the public.
Yeah, no, absolutely. I totally agree. I think people are using AI now to kind of maybe sanitize their emails, get feedback on maybe if the emails sound better or more empathetic. But then the problem is you start to smell that it was written by AI just because it was too polished. So at least at a minimum, force a few typos in your paragraphs, so you're human.
Yeah, actually a couple of misspellings, then it looks like it's real.
Yeah, exactly. Yeah. I would say a big thing too is, the companies that are really going to innovate are the ones that are going to have an in-person component, right? So really building a community around you. Obviously we're doing this digitally, but have an in-person cocktail party, once a month, a meetup group where like-minded individuals can get together and share ideas, share notes. That was one of the concepts that Benjamin Franklin talked about, like having an affinity group for like-minded professionals, like almost like a mastermind, right? I don't know if he coined the term, but if you think about it, there's this book,
like a board of advisors, for you,
exactly,
for your firm and for others. You give them feedback to their company, and they give feedback to you, and I think that's awesome.
Yeah, there was a book that one of my professors wrote about just lessons from Ben Franklin, and one of them was not to drink, right? But he had like 10 lessons.
Next chapter.
Yeah, but one of them was like, if you think about it, right, you're drinking, you're spending money on alcohol. Obviously, look, I'm in New York, so I socialize and I go out and try to network with people, go to cocktail events. But it's interesting. There's fundamental lessons that are old school that are timeless, right? And one of them, obviously, as we mentioned, is just like kind of building, surrounding yourself with good people, trying to, obviously stay on top of things. I'm trying to like pull up something really quick to see if I can, share a couple of them, but those are some of the few that came to mind, in terms of just kind of sharing,
that's like 200 years ago, and it still applies now. I think what you're doing is socializing. I'm sure he's taken like to a point where people are a drunken mess and they don't present themselves well, and they've done it for days. And we're not talking about going out to a nice steakhouse and ordering a cab. I don't think that's what was meant. But the point is that a lot of the things, and I guess you have a couple more quotes to share, to this day, here 2026, still holds true all these many years before the birth of the internet, maybe before electricity. And some of the great quotes from Washington and so forth.
Yeah, here it is. So, couple timeless lessons from Ben Franklin, right? Industry and productivity. Look, staying on top of things and just always trying to do something that's helpful, right? Whether that's building something or supporting someone, just kind of constantly staying employed in useful tasks. That's one of them. Frugality and financial prudence. Obviously, that still carries weight. Especially in your line of work.
Oh, yeah.
Continuous self-improvement, reputation and integrity. That's a huge one. And then
which was Ben Franklin all about. Yeah.
Yeah. And then
the New York and London connection. I read something, again, I read a book about presidents, and Ben Franklin went to England a number of times. Those boats and those waves, I don't know if I would have been able to make it. It took him like 3 months or 4 months, or whatever it was. And there was pirates out there. It was very dangerous. And he made several trips from the U.S. to Britain. And so when you hear these type of quotes that come from him, he's very real. I mean, he's these are not luxury liners back in the day, right? These are not
Absolutely.
easy trips, and he did them. So again, hats off to him.
Yeah, and then from Poor Richard's Almanac, I'll give you a couple more. I mean,
Yeah,
early to bed, early to rise. Diligence is the mother of good luck. So all these are kind of related to investing, right? An investment in knowledge pays the best interest,
right.
and then haste makes waste. So
Yeah, investing in yourself is
still
probably the
relevant.
best one of all those. Again,
Hmm.
I have to say for your viewing audience, like when it comes January, we all turn over a new leaf or try to, and I still like to snack. Some of
Hmm.
these things I broke, but the one that I started a few years ago that still works every week is I try to read a book a week. Now it's usually one book every couple of weeks, but
Yeah.
that's been one of my best things, one of my best New Year's resolutions that stuck, and that I love reading, especially
Hmm.
about history and nonfiction and so forth.
Yeah.
Share that with your viewers that I had a friend share that with me, and then I took to it, and now we have a quasi book club. But there's just so many great books that are out there. And by the way, for your business and for my business, a book I could recommend called Scaling. Dr.
Scaling.
Hardy, along with
Hmm.
with Sullivan. I'm sorry, with Sullivan, was it?
Yeah.
Dan Sullivan. Yeah, and there's like 3 or 4 books that are out there. Not how, but who.
Yeah.
And 10x is easier than 2x, and this stuff will fill your mind and all soul and all that type of stuff. So
Yeah.
I still believe that we still have to, even though we're out of college, and I mentioned my background in college, we're out of college. We still need to learn, and there's some great stuff out there.
Do you think there's a market for people that want to still, so I'm doing Audible now. I used to read books all the time. It's just tough to block off time,
Sure.
with two little ones at home. So what I do is I just try to digest as many Audible books as I can while
Yeah,
I'm working
that
out.
works too.
But I saw this in my feed. It's the only living trust book that you'll ever need. I just saw it like on an Instagram ad, and I was like, "Oh, cool, let me buy it." And I just bought it, and it's here. So at some point, I feel like it'd be a nice little guide to read through, maybe if I want to learn something more about trusts. But do you feel now with Gen Zs, there's a need to kind of get away from screen time and have more in-person connections and
Oh
obviously
yeah,
like have more physical books versus kind of I haven't done Kindle as much. I mean, it's just, again, just sitting down and reading it has
sure.
been tough to kind of block off time. Although I do love reading, but wanted to just see if there's any other trends that you're seeing in terms of just kind of more human or manual physical connections.
Yeah, but there are definitely some apps out there that condense the story down to like 10 pages.
Hmm.
So if you kind of want, and if you like it, go deeper.
Yeah.
Look, I'm more of a tangible guy. I come from a time where I was born before the internet, let's put it that way.
Hmm.
And I'm probably one of the only people on my block that still get a newspaper, the Orlando Centennial, like what the newspaper. And again, I like the tangibility of the book, and I'm
Yeah.
highlighting, I'm putting asterisks on it, and the
Hmm.
back notes, I'm blurring. And I just finished the book over the weekend. I got to take those notes up in the back and put them into my organization. But
Sure.
I guess the point is, I really, again, for me anyway, that
Hmm.
backlight never worked for me with Kindle for some reason. Of course, I do a lot of reading on a computer as it is, but that book is just something. Is like, hey, that's my free
Sure.
time. That's something I enjoy doing, and the tangibility of, again, yellow stickies and things.
Yeah.
It just makes it come alive a lot more, I feel, than
Absolutely.
through a computer. Yeah.
No, it's amazing. Well, I know we're coming up on time, Ken. This was amazing. I feel like we had a fun time jamming.
Oh yeah.
I always end every conversation with just one piece of advice. Could be from a mentor, could be from a family member, could be from maybe a colleague, but just looking back, just one piece of advice that you want to leave us.
So I'm a big Dr. Wayne Dyer fan. I got a chance to meet him over the years, and you probably saw him on PBS over the years.
Sure.
And he always says, "Think from the end," meaning,
Hmm.
if your goal is this, put it out there in the universe.
Hmm.
Again, not in an egotistic way. Maybe it's through prayer,
Yeah.
through meditation, subliminally before you go to bed at night. Which every night we marinate. So I always make sure I put some good things. And look, there's always health
Hmm.
scares. There's always things that are going on with the children, and there's always. But again, I just love some of the messages from Dr. Wayne Dyer. And he asked me to stick one, but
Yeah.
live from the end, meaning it's already here. Whatever it is that you're trying to get, it's already
Hmm.
here. Have the great emotions around it, and the universe will figure it out for you. But
Yeah.
again, I would say anything to do with Dr. Wayne Dyer and any of his quotes are really helpful.
That's amazing. Well, hey, Ken, thank you so much
Thank you
for all that you do for the community, and thanks for sharing all your wisdom. This was a lot of fun, and
Thank you, Joe.
everybody
Wow, we
else.
covered a lot of topics.
What's that?
Sure. We covered a lot of topics.
Yeah, that's what happens when you don't rehearse. You just
Yeah.
kind of you just have a real fun conversation. So
Sure.
really good time, and everybody else in the audience, have a great day. Catch up soon.
Great.
All
Thanks,
right.
you too.
Bye.